Hello and welcome to this week's Shoot the Moon podcast, broadcasting live and direct from Revenue Rocket World headquarters. As you know, if you've tuned into this podcast in the past, Revenue Rocket is the world's premier M&A advisor and growth strategist for tech-enabled services companies. With me are my partners, Matt Lockhart and Ryan Barnett. Welcome, guys.
Great to be here, Mike. We sometimes give a report on things here in the Great White North, and happy to report that I think spring has sprung. So we're excited. We hibernate for a few months in the winter, and it's exciting to feel the sun. Also, exciting topic today, Ryan. What's going on?
Yeah, it's a great time for a little spring cleaning, and one of the things that people do in their P&Ls is sometimes spring clean with the lines of things they spent on when it comes to financial reporting. And so, what we want to talk today is the concept of add backs to EBITDA. And so, if you're not in the M&A world and have not gone through a process or not seen as the term add back might be unfamiliar. And the easiest way to think about this is that an add back is an expense that's typically non-recurring or discretionary or even owner specific. And the biggest thing is that it is expected to disappear once it's gone. If you think even about the definition of EBITDA, the earnings before interest, depreciation, amortization, depreciation and amortization, if you think about that, you've got that net income before all of those things that essentially are things that are expected to disappear post-close. And we get a lot of questions from buyers and sellers of what is an add back and what's an appropriate add back. So kind of a golden rule out there: if it stays, it pays; if it goes, it grows. So essentially, if it goes away, it's going to be that add back and have a multiplicative effect. But if it stays put, you're going to have to pay for it. So today we want to get that definition of what an add back is. We'd like to talk about some scenarios of clearly what's in or out. And then I'd like to talk, Mike, about a little bit about some of the gray areas that are out there as well. So, Mike, if we define that add back as a non-recurring expense expected to disappear, why is that important when it comes to the calculation of EBITDA, when it comes to deals in the IT services market?
Well, as you mentioned, Ryan, all deals really in the IT services market are based on a multiple of EBITDA. And there's a variety of factors. You guys have probably heard that term or familiar with it. It is earnings before interest, taxes, depreciation, and amortization, EBITDA. It does typically get calculated in a trailing 12 months EBITDA. That's why we've talked about in past podcasts, it's important to have good corporate financial hygiene, be able to tell what EBITDA is, and have sort of defendable financials when someone looks at it. When you think of an add back, an add back is typically something that adds to that EBITDA that maybe is a discretionary charge that's made for oftentimes owner benefit. So sometimes that won't continue if you were to do a transaction with someone. So easy ones that are defend are, let's say you have your car lease if you're an owner and run through the business. And you, that won't continue. After you own the business, you're going to not, need to run that through as an expense. So it's easy to add that one back to EBITDA as an example. And there's a variety of other owner discretionary one-time expenses or other things that might, not continue post-close. Sometimes people have sports tickets or boxes or things that they, run through their corporate P&Ls that are, justifiable and easy add backs. Also, some one-time expenses often are considered an add back. So one-time expenses might be some legal fees you had in a particular year that are anomalous, or they might be, let's say you do some estate planning and you put a trust in place and there's a one-time, legal fee for that. That certainly would be a justifiable add back. Or you're having an M&A advisor work with you, for example. That's a justifiable add back. It's one-time expense, happens before a transaction, won't continue post-deal. a justifiable add back. Now, there's certainly plenty of things that are in the ongoing business that people try to put in for add backs that will need to be continued post-close, that if they weren't continued would harm the business. Oftentimes, the easiest way to think about that is not a justifiable add back, even if it's a contractor type expense. If it's if it's part of the ongoing operation, it likely is not qualified as an add back. Hopefully that helps.
Yeah, Mike, thanks for getting us going here. And I would like to say that seems like a big battle between buyers and sellers. Battle's maybe a little harsh, but it is definitely a point of contention or deep analysis. That's probably the word we're looking for between our buyers and sellers. And the reason for that is buyers, they're looking for kind of that really true operating cost of the business. And sellers, this is one of those times where you might hear the term seller's discretionary earnings. This helps them boost up kind of that seller's discretionary earnings. However, every add back that you're going to take a look at is going to have scrutiny. So I think one of the things that when we think about the concept of add backs and walking through them, having a defensible position on each add back is critical to help you as a seller be able to claim those add backs, increase EBITDA, and if the deal is based on a multiple of EBITDA, ultimately increase the payout that you have. Matt, I'd like to help bring you in here on the conversation. Mike had mentioned the owner's compensation that is typically above market is going to be a pretty clear add back. However, when you think about that owner's role, there's a lot of confusion of what can be an add back or what's not an add back. Can you help us just dig into the discussion about an owner's compensation and how that should be looked at when it comes to add backs?
Sure. And great question. And I don't think that it's not a clear line, right? It really needs to be thought through as you frame the question in terms of what that owner's role is. So let's look at a couple of scenarios. Say it's maybe a smaller firm, and the owner is obviously providing the top level leadership and guiding the firm. And oftentimes in smaller businesses, the owner will also be providing sales management or could even be the number one salesperson, right? And say that owner is looking to sell the business and he's found a suitable buyer, and they have agreed that there can be a short-term transitionary period for the owner. And so the owner in this scenario is being paid market, he's paying himself what would generally be seen as market, right? And he's saying, well, I'm going away. And so, I get an add back, right? Because I'm going away and the cost of my salary is going away. Well, the buyer may look at this scenario and say, well, yes, you are going away. However, you are providing some critical functions in the business that don't exist when you leave, right? And we are going to have to replace those critical functions, right, within the business. And so it's really not appropriate for that owner to be able to claim a full add back. Now, using that scenario, maybe the decision is, well, we really need to hire a sales leader. And because that's a critical function that you're taking, we understand that, and we've agreed that you can transition out of the leadership and we will be able to consume the leadership responsibilities in your role, but we can't consume the sales leadership aspect. And yet, a sales leader is going to be paid less than that owner's compensation. And so, pretty simple math. You say take the owner's compensation minus, right, the compensation that would be expected for a sales leader. And then there is still money left over that would be an appropriate add back in that scenario. So, I bring up the scenario aspect because you really need to look at it on a case by case basis as to what the role the owner is playing and what he's built within the organization to be able to continue as a going concern when that owner leaves.
Matt, I think one of the areas where we typically start to see confusion is this definition of this setback, and it's almost on every line that we see. There's some level of an owner add back for their compensation, and I think the one scenario we see the most, which sellers really have the hardest time understanding, is that if you're staying with the business, you cannot add back your salary. That's kind of the basic way to go. If you're selling in and you're with it, you're staying on, that's not an expense that stops. It's still there. So you'll likely see that you'll have an employee agreement, or you might have some kind of contractor agreement. You're going to still get paid in a different way, but it's not going to have that multiplying effect that you may see within a transaction. I think we see a lot of kind of mistakes or people misinterpreting what this means. That if your salary is an add back, that means it's not going to continue going forward. If you think about other add backs in this case, we're just very, very clear. If you have an exiting owner, absolutely, that compensation is going to be on there. Mike, you had mentioned M&A legal fees. When you think about some of the ongoing fees, and Matt, Mike, if you think about those fees of a lawyer, the one-time transaction fees that are associated with M&A, that's pretty clear. That's not going to happen to your company again, and that's going to go away. But how do you view expenses that may have this kind of one-time charge versus a ongoing charge? What do buyers look for in those types of scenarios?
Well, you have to sort of think about, walking around the shoes of the buyer, right? If you're a seller, and say, if I'm going to operate my business post-close, you really have to use this litmus test that says, is this an expense that's going to continue in some way, shape, or form in the future? So, that's the same reason why an owner's salary doesn't get added back. Someone's going to have to manage that business. Someone's going to have to, in some cases, sell at that business if that's part of the role that the owner was playing, even if they're going away. And, that has to be rationalized. And so I think, that's an important point. To answer the question more directly, I would say, certainly there is always some discussion around add backs, as whether it's a gray area or not. Some of that occurs like with rationalization of staff. Well, I rationalized 3 people. We had a riff. Those guys are gone. Well, that's fine. When did that occur? Do you really need them in the business? Is it a role that needs to be funded or not funded? Those are things that you have to really unpack if you've sort of had a riff and a way to optimize profit. Now, you may have done that, a reduction in force, riff is what I'm referring to, as a way to optimize profitability. You may have done that to prop up EBITDA because you knew you were doing a deal. It's up to the buyer to sort of make sense of that. And I think it's up to you as a seller to be pretty forthright about, hey, we're getting by, running more lean. Maybe we could use a person here. We'd probably hire one if we weren't doing a transaction. Just be more open and transparent about that. Certainly it's important to think through that like a buyer, like, what do I need to really run the business? And a recent example we had was on marketing expenses. A company outsourced a bunch of marketing, had some marketing going on internally, and they're wanting to add back all those marketing expenses. Well, to continue to grow the business after the transaction is done, I'm sure the buyer is going to want to continue to do marketing, right? There's going to be marketing expenses. There's going to be sales expenses. There's going to be office and rent expenses, things that need to be there that were there pre-transaction that would just never qualify as an add back. So, the advice I would give any seller is to think through, is this kind of a one-time thing or an owner benefit thing? Okay, that's good enough. You can sort of justify that if that cost isn't going to continue post-close. But if it's something that you would spend your money on to continue to run the business, if you're running it, continue to own it and run it, then it probably is not going to qualify for something that would make sense to add back.
Ryan, you brought up the legal fees. I think the legal fees is an interesting one that could be seen as gray area if somebody doesn't do what Mike was just advising, which is to be, really transparent as to what these costs are. So, and the reason I bring up legal fees. So, say you employ a lawyer to do contract review on an ongoing basis for new contracts, new supplier contracts, or new master services agreements, and so on and so forth. And say in the year prior to you selling the business, there was a lawsuit for whatever reason. There was a lawsuit that was in place, and you don't have a history of lawsuits, but it just happened to fall within that year prior to the transaction. So the correct thing to do would be to detail out these different legal fees and say, okay, look, you see an increased cost, right, in legal fees in the preceding year. There was a lawsuit. This was the situation. It has all been resolved. There is no, pending lawsuits, et cetera, et cetera. And that cost, say it was $100,000, that cost is an appropriate add back. Now, the total legal fees were, say, $135,000 because there was $35,000 being spent on an ongoing basis in contract review. And that $35,000 was there the year before, or maybe it was $30,000 or whatever it may be. Well, that $30,000 or $35,000 is not add backable, because that is something that is a fee that you are using to continue to run the business.
And I think you hit the litmus test great. If it continues and it's ongoing and it's something you're used to paying for, and that could be a role or it could be a service, that's likely the buyers are not going to let you allow to have that add back. And Mike, one thing that's just more of a technical nature, but I think it's important to talk about, and this goes a bit back to owners' compensation. But when you think about distributions that are allocated to individuals or people, those are sitting on the balance sheet. It's important to know that if a add back is to be considered, it's got to come from the profit and loss. And just Mike, is there anything to add to that, or have you seen cases in which non-P&L items have been considered, or any advice to sellers that to make sure that those items come off the P&L?
Yeah, this is a super common mistake, Ryan, that sellers oftentimes make. They may take the lion's share of their income, or in some cases, all of their income, as distributions, owner distributions, right? Owner distributions are a balance sheet item and do not hit the P&L, and thus do not impact profit. And when that's the case, they essentially come out of retained earnings. But when you're running a business and you want to quote unquote add back, logically you would think, well, I should add back my compensation or a portion of my compensation because it's above market, let's say. But if it hasn't come through the P&L, right, it hasn't come through a normal payroll function on your P&L, then it cannot be added back. And I think that's just really, really important to know. A lot of times we'll see sellers who will say, well, I paid myself, above market, and, X, Y, Z dollars. And so that above market portion, we want to add back to the P&L, even though it came through the balance sheet. Well, that's not appropriate, nor would it be accepted. Pretty common thing that we see. And so just, as a seller, think about that. Again, walk them on the shoes of the buyer. If it's never impacted the P&L, it's hard to add it back to the P&L. And owner distributions happens to be one of those categories.
Great summary there, Mike. And on that note, there are certainly one-time revenue and profit that is also not appropriate for an add back. During from 2000 through 2003, even through today, you'll still see a PPP payment go on to essentially a revenue source. And buyers, you got to be careful on to make sure that the revenue is really associated to the revenue delivered, not necessarily a one-time program that's out there. Switching gears a little bit, Matt, I'll start with a punchline here, in that oftentimes when two businesses come together, the synergies that are created in that business for perhaps overlapping roles, overlapping systems, those synergies go to the buyer. In the context of add backs, have you seen a scenario where people have tried to add back perhaps their ConnectWise system? And if, let's say, you've got ConnectWise and you're selling to ConnectWise is a big professional service estimation tool used by most or many managed service providers. And let's say your buyer also has ConnectWise or Kaseya, and your buyer has Kaseya. Can that be an add back? Or is that just simply a case of the buyer gets to rationalize that fee, those costs as they go forward?
Yeah, I mean it's clearly not an add back. If you go back to what are the costs that you need to continue to operate the business, right? And that's as though it was a standalone business and moving forward. I think that is the sort of the clearest line, and a system like ConnectWise, or you could say any ERP system or any CRM system. And the seller could say, well, you've already got one of those, right? So you don't need it. And so I get the add back. That's just not the way the game works. It won't be accepted. And so you can't think along those lines. And, it does simply go back to that principle that you started out with, Ryan, that are these one-time expenses or discretionary expenses or personal owner expenses that are going to go away. The mere fact that the buyer can rationalize, that's good for them. It's good for the buyer. It's one of the reasons that people look at making acquisitions is that they can spread their costs out across a larger revenue stream and more businesses. And so that's a real positive for the buyer, and sellers need to go into the process understanding that and enabling, and really quite honestly, we guide our sellers to be able to point out the benefits that can come. Now, it can't be added back, but in negotiation of what the ultimate enterprise value is, there is some value there, and it can be incorporated into that negotiation, as opposed to what are correct and justifiable add backs.
Yeah, great point.
I'm going to add a point there, Ryan. Buyer synergies are interesting because, buyer synergies can be shared with sellers, but this is how. If you structure a deal a certain way, you may have an earn-out, let's say, or a sort of a contingent payment. And if you're able to create more profit through the combination of those businesses, even though they're buyer synergy related, it could impact your ability to make your earn-out. Likewise, if you roll equity, as an example, and now you're an owner in the new entity, obviously those buyer synergies you're going to take advantage of. either through, in some cases, distributions or increased enterprise value. And so, you certainly want to encourage owner synergies, particularly when you're going to be able to participate. In more and more deals, sellers are able to participate in buyer synergies sort of through these vehicles. And so don't be thinking of it as a win-lose type negotiation. It certainly is win-win, and there are pretty firm and established buyer synergy areas that are an opportunity. G&A related expenses oftentimes have buyer synergies. To your point, Matt, like, back office and accounting, there may be some synergies. There may be some synergies and savings and licensing. You get some to more seats, you get a bigger discount. You're able to, leverage outside professional services maybe at a more effective rate. All those things impact what would be perceived as a buyer, but oftentimes, depending on how you structure your deal, you get that benefit as well.
That's a great point. A lot of this does have to deal with deal terms, and I'd love for us to refer back to one of the podcasts because I think it's a good topic. Is that a EBITDA multiple is not an offer, and so just keep that in mind. Even though we're spending a tremendous amount of time talking about some nuanced things on making sure that EBITDA is to what is accurate. And sellers to really thinking through this process of what should I include in this, and the multiples in their space are guidance if they're not an offer, and that offer is going to be based on many things, including something like an EBITDA multiple. I've got a super tactical one. I just want to address it. I think Mike, it might be best to cover this one just quickly. We see a lot of P&Ls that have seen a reduction in rent, and sometimes that reduction in rent or a sublease can be put as an add back. And we're starting to get some questions on, is that legitimate or not? Can you just either Mike maybe start, or Matt, feel free to jump in here. When you consider rent and these reductions, how is that viewed as an add back?
Well, there's a fair amount of moving parts here in rent and rent add backs. Oftentimes, IT services companies, because they tend to be, pretty strong, high cash flow businesses, will buy real estate on the advice of their either counsel or an advisor, or, maybe you buy a small building somewhere, and, and then you have a rent that's not market. Like you're either charging yourself too much rent, sort of as a tax strategy, or, you may have some other off-market rent sort of scenario. And I think it's important to understand, again, walking a mile in the shoes of the buyer, that you have to try to forecast to the best of your ability what market-based rent would be post-transaction, and, what that means to the P&L moving forward. That really is the litmus test to determine whether or not any portion of that rent would be an add back or a reverse add back. In this case of maybe you're charging yourself above market rent, renting space from another one of your corporations because you own the building. And so, again, the advice is just, think of it like a buyer. What's the likelihood that your sublease tenant, in the example you used, Ryan, is going to stay on? Is it a month-to-month thing, or is it a longer-term thing? Really, will it be material over time? Are you going to need to take that space back if you grow? Likely you're going to do a deal because there's more opportunity with your buyer than there would be on your own. So maybe you need to ask those sublease tenants to leave so you can have that space back to grow into. All of those are considerations. And you have to sort of think through it again as a buyer to say, what's the more likely expense there, and does it qualify for an add back or a reverse add back?
Ryan, you brought up the fact that we've, in the past few years, right, we've seen a little more of this. I think that the pandemic, obviously had a bit of an impact on this, but even more so, some organizations have rightly so made the decision to move from an in-office to a hybrid or a fully virtual organization. And the business has thrived, the business has grown. And, maybe that decision was made and there was a year left on the rent, right? And they've said, well, we're gonna swallow it because it's the right thing to do for the business. Right. And so I think that we've seen more of those scenarios, probably less. We will see less of those moving forward, but that is sort of a nuanced situation that needs to be talked through and could potentially have some merit as an add back.
Yeah, great feedback there, Matt. And Matt, you can feel free to keep going with this question. And I think this is the last question I got for in or out, nuance, gray kind of questions. But one of the things you'll see on a P&L is oftentimes employee or management bonuses. And I'd love to get your take on this, Matt, on when you think about a bonus. What one phrase, everyone thinks their bonus is special, but buyers just think it's payroll with a hat. I'd love to get your take on this. And if you think about bonuses, there could be one-time bonuses, might be an annual executive bonus, there might be a performance-based bonus, and there might be a commission or profit share bonus. And so if you think about it in those senses, Matt, how should can bonuses show up as an add back?
Well, I think that you framed it. There's a number of moving parts, and there's a number of different types of bonuses. Those bonuses that are an ongoing use for compensation and the system that you've set up to drive the performance of your business will likely continue forward. And when they continue forward, then not appropriate. Other bonuses, or maybe a profit sharing scenario that you brought up, those may not continue forward and with a new business. And one could see a good, strong argument that those types of scenarios will not continue forward. And so then merit a good discussion as to the viability as an add back. So I think it really depends on how and what these bonuses are used for as part of the overall compensation philosophy of the business. And then again, are they going to continue forward?
Yeah, great. Thanks for breaking that nuance. There's all sorts of cases here that and you can see the back and forth that you have here. And I think that's part of this whole discussion really comes down to that there is a back and forth. And so buyers are always going to redo your ad backs. That's just the reality of it. So they're going to cast your forecast and they're going to recast and they're going to take a look. I would say that if you get too aggressive with your ad backs, that starts to erode trust. And so when you're going through this whole process, you're trying to really show transparency, you're trying to build trust. And if you have a big number that's out there that's driven by ad backs, that can erode that trust. And also just, overinflated EBITDA that ultimately is going to equal a lower valuation when the truth comes out. So if you're inflating EBITDA by utilizing some aggressive ad backs, buyers are going to take a look again. If you think about it like a dating app profile, you can Photoshop your pictures, and you can Photoshop your EBITDA, but the buyer's still going to see you in daylight eventually. I mean, they're going to take a look. And so just keep in mind, whatever you put in here, they're definitely going to take a look at, and they're going to analyze to a point that may erode the trust that you've got. Mike, Matt, I love this. We've done this podcast before, but has there been an ad back out there or a good back story that could make me chuckle, and just something that was over the well that you just thought, oh my gosh, I can't believe this is even on here.
How much time we got, Ryan? Oh, we have some funny ones. We have some certainly ones that have been ordered on even being legal. I mean, I've seen ones where people were paying for their, not to be too scandalous here, but paying for their mistress's home and a large fee to them every month for, I guess, their support, and that individual business owner trying to justify that. I've seen, lots of issues around planes, trains, and automobiles where people have tried to justify those ad backs. Even large automobile collections and things like that would make sense as an ad back. But, some of them are interesting, some of them are illegal, some of them add a lot of doubt around the ethics of the seller. And I think when you think about that, you really have to not only think about what you're going to put into ad backs as, does this erode trust, right? Because to your point earlier, crazy ad backs do erode trust and even cause the buyer to question whether they can work with you, even if it may be, perceived as something that's legitimate. But, I would just say it, and oftentimes it'll also question someone's, not only ethics, but maybe it questions their business judgment. If it's an extreme expense that's not sized for the business, even if it's for personal benefit. Certainly have seen, many of those as it relates to luxuries or trips or investments in things that, may not be interesting. We've also seen investment losses tried to be put in as ad backs for things pursuant to the business or adjacent to the business that are sort of arm's length. So, when I'm joking about how much time do you have, there's certainly been a lot of things that have been tried. I think it's important, again, to walk them out on the shoes of the buyer to make sure, one, they're reasonable, two, they're defensible, and three, that, it doesn't make you look like you're just, doing a land grab for EBITDA when that's not appropriate.
Safe to say, careful with those personal airplanes, right? But in reality, and good guidance, if you are thinking that your time is coming, right? And we always talk about that's the very first thing is it time to look at a new chapter with your business? And you're one of those individuals who for years and years and years has run of a large amount of personal expenses through the business, and understand why people do it, right? And it can be for ease, there can be some tax benefit, et cetera, et cetera. But that your time is coming. Just a real, just smart thing to do is to stop running all your personal expenses through the business, right? To Mike's point, it can raise questions, right? It can make the discussion as to what is applicable and not applicable for ad backs to be more difficult, and can be, as Ryan said, can turn into a battle, if you will, and ultimately can make the process of trying to get your reward for your life's work more difficult. So just a good piece of
Yeah,
advice.
absolutely. And I'd say the best piece of advice in this is that if you run a business that generates great net income uh, without ad backs, that's probably the easiest piece of advice that we can give you, is that if the better that net income line, there's buyers will have audible groans when they open up a spreadsheet that has ad backs a mile long. And so sellers, absolutely, you're justified in pointing those out. You should. And I'll put a plug in here. You work with an advisor to help you find that. That's one of the big roles that revenue rocket plays when we position companies to go to market, just to make sure that your expenses are fairly captured, that you are getting what you deserve and your exit. So make sure that you have the right person by your side before doing this. Mike, Matt, anything else you want to cover on the topic of ad packs here today?
No, Ryan, I'll just accentuate your last point there. Run a great business, right? And run a nice, good, profitable business, and work with an advisor. We talk all the time. They have clean books, right? All of this is going to add to. In addition to that, appropriate ad backs is all going to add to the enterprise value that you're going to be able to capture within your business. Mike?
Yep, totally agreed, Matt. I think as long as your numbers are defensible and you're running a easy to understand sort of set of financials that are standardized, and better yet, you're operating the business in the top quartile of your peers for both revenue growth and profit realization, you'll be in a good position to transact a deal, and you sort of have people understand your ad backs. So with that, tie a ribbon on it for this week's Shoot the Moon podcast. Please tune in next week. We'll unpack more topics around M&A and growth strategy in the IT services realm. And with that, make it a great week. Take care.